The markets are really cheering that inflation data that we got today. It is Wednesday, August the 12th, and this is Markets with Megan. If you like this podcast, you can subscribe, hit the alarm bell, share it with your friends, family, colleagues, anybody who's interested in those headline economic data reports that we get, what it means for the markets, and then also someone who can dig into those headlines and give you the true story of what's going on in the economy. So let's dig into what we got today. This was the Consumer Price Index. It's been a much anticipated report. It's for the month of July, and the report came in pretty much on the spot when it comes to expectations. So on a month-over-month basis, the headline Consumer Price Index rose 0.1%. That's after a 0.4% decline last month. The core CPI rose 0.2. That was after a flat reading last month. The CPI on a year-over-year basis rose 3.5%. That's the headline number, and then the core number rose 2.5%. Both of these were about 1/10 lower than the rise in the last month. So when you look at the markets today, they're celebrating this. It came in as expected. It is slightly lower than last month, but as expected isn't good enough in our opinion. When you look at some of the details in this report, we're still showing that there is a lot of pressure for Americans in this inflation data. Some of this is quite sticky. We look a lot at the service sector because that is where Americans spend the most of their money. And what we're seeing is that the service inflation actually, after rising 0% last month, jumped to rising 0.2%. So we're back on that upward trend. 0.2 isn't awful, but again, we're trending in the wrong direction with this. On a year-over-year basis, it's up 3.1%. When you X out energy, which is a very volatile item, it also rose 0.2. So it's growing about 3% on a year-over-year basis. We saw pressure in owner's equivalent rent. That did slow a bit the prior month, but is back up again. In apparel, we saw a rebound in that. Airline fares are up 25% on a year-over-year basis. And then things like education and communication, they rose 0.6% for the month. So there is pressure underneath of this. We are happy that it didn't come in higher than expected, but this isn't necessarily something to completely cheer about. You're going to read that the Fed will most likely stay on hold in September because of this data. It's a little early yet. We still don't have the PPI, which is the Producer Price Index that we'll get next tomorrow, and then the PCE, which we will also get in the coming weeks, and that is the Fed's preferred inflation indicator. What do we think about this and what the Fed's going to do? First of all, core CPI has been above the Fed's target for 63 months. And even though it's coming in as expected, this compounds month after month after month for consumers. There has to be something done about this. What the Fed has been doing for the past 5 years is not working. We do think that the Federal Reserve that's in place right now is very hawkish, so we're not taking September off the table yet. There's still some more data pieces. We do think for sure you'll get at least one rate hike this year. Whether that's September or December, we'll get that information here in the coming weeks to get a little bit more clarity. But our opinion, the Fed does need to raise rates. We do need to slow this liquidity that's in the system to bring these inflation levels down. That's all we have today. We'll be back with the Producer Price Index tomorrow. And if you want a history of our podcast, you go to marketswithmegan.fm. Thank you.